Welcome to the All Financial Hour podcast with Steve All.
Steve, I got to put you to work a little bit here.
No, do we have to work?
We have to, man. That's why the people are here.
I'm 65 now. I should be retired.
I know. Well, listen,
People ask that
Stay
question.
with us. Stay with us.
People ask me, when are you going to retire? I said, I love doing what I'm doing. I mean, I sit at a desk all day long and talk to people and have fun. Help them figure out what their retirement's going to be like. I had a couple that was in there earlier this week. It was like, go do something. I promise you, my job will be to tell you, if you're spending too much money, to slow down. You saved all of your life for someday. Someday is the day you retire. Because I think a lot of people have that fear of running out of money in retirement. If I do too much now, I won't be able to get by later. And I think that is the biggest advantage of having a financial advisor that you're dealing with, is it's our job to look at what you're doing and say, is it sustainable?
Steve, we've heard the word recession a lot lately with this recent volatility. MarketWatch interviewed 6 financial professionals and asked this question. They said, if you're worried about a recession, what should you do? Here are some of the things they came up with. I want to get your thoughts on this. Number 1, build up cash reserves. Number 2, pay off high interest debt. Number 3, consider adjusting your risk by rebalancing. Number 4, don't try to time the market. And number 5, just stay calm. So what are your thoughts on this?
I think that's what my job is to help you with financial planning. High interest debt is the killer of most people's retirement. Credit card debt's the worst thing that people can get into because there's not a whole lot out there that we have that you can make 20, 24, 25% to cover it. Consider your risk versus the reward, rebalancing. I think that's one of the important parts of investing that people don't look at. They just keep pouring on. And when markets get too high, what normally happens? They fall. Well, if you got too much equity at that point, you're going to take a bigger fall. When markets get too low, you don't have enough. So rebalancing is very, very important. Timing the market usually does not work. We'll just put it that way because I can't say never because it probably has worked, but it usually doesn't work. Timing the market's just something. Nobody's got a crystal ball. I don't have a crystal ball. So I think the most important thing they could have, of which all of these things consist of, is a retirement plan. So what does that retirement plan consist of? It talks about, do you have an income plan? How are you going to replace your paycheck? Do you have a deal that looks at taxes? Because that's going to be an important part. Most people think that you're not going to pay taxes in retirement, but most people do. What about Social Security? When should I take it? What's the optimum time to be able to take it? It's not a simple calculation. What about estate planning? For those of you that have done an excellent job of saving, how do you want to pass that assets on to your children? Investments, as it said, adjusting your risk. I think investments should be based on need, not greed. Give me the best return that I can get with the least amount of risk possible. How do I protect those assets for the gains that I've already had? Because sequence of return is so important, especially those early years in retirement. If you're concerned about the volatility of the current market as it's going down, and you're in that retirement red zone within 5 to 10 years of retirement, give me a call now. Ask for the comprehensive retirement plan. Let's give you something to focus upon so that noise that goes on out there in the market doesn't take quite as much emotions. Give yourself something to focus on. And what you should be focusing on is a retirement plan.
The so-called 4% rule, it's been around for 30 years. But economist Michael Fink tells The Street that, for the most part, the rule is actually too conservative for human nature. Listen to this.
I think people should decide if they want to live better in their late 60s and 70s. When you do have the physical capabilities and the cognitive capabilities to enjoy your life more. I mean, there's not a whole lot of 95-year-olds that are going on world vacations. And the fact is that you can't enjoy it as much in your 90s as you could in your 60s or 70s. So I think you should have the power to be able to choose the slope of your spending. And in reality, it does appear that people do spend less as they get older.
So let's break this down here just a little bit, Steve. Do you take a similar approach when calculating withdrawals for clients, or do you subscribe to this 4% rule?
Well, there's different ways that we can build an income, because that's usually the question that most people have. How am I going to replace my paycheck in retirement? And the 4% rule. I will agree with Michael that your spending overall, you probably won't be traveling when you're 90. We currently don't reduce the people's spending as they age, because what you're going to be spending things on is going to be completely different. You might not be cutting the grass. You might have to pay somebody to do the things that you're doing now. What usually happens with medical bills as we get older? So the inflation rate on medical is much higher than it is for food and the other things. So when we build our plans, we kind of keep that inflation going. We don't sit here and say somebody is actually going to spend less. I do agree with the fact that I believe that if clients have the available assets, make sure you do the things that you really want to do, that bucket list items. Let's put those in the financial plan, that those are going to happen over and above your average spending. But a lot of people ask that question, Steve, how am I going to replace my paycheck? I look at it, we got three options. If your Social Security and pensions are $2,000 less than your living expenses, we got to come up with a way to fill that $2,000 gap per month. We can do what we call a personally funded pension. We can go out and shop and say, okay, give me a guaranteed amount for that $2,000 a month, and I'm going to turn that on income. I don't care, 2 years, 3 years, 4 years, 5 years, whenever you're going to retire. And we're going to turn on that income stream. And it's going to be for both you and your wife, if you want a joint account, that it does cover that. That's a personally funded pension is the way I look at it. It's guaranteed by an insurance company. That's one way we can do it. Then Michael talked about it, the 4% rule. He didn't mention the fact that the 4% rule only works 85 to 90% of the time. Well, if I build in something to that 4% rule that says, I want to build in 2 to 3 years of additional money. Why? Because what if you would have picked 1999 to retire and the first 2 years were a negative market? I want to build in a cushion for that 4% rule. Mm-hmm. Set that money aside, and then I can take that 4% out. I could also look at building a stock portfolio, or a bond portfolio. They're going to pay around 4 to 5%. It's about that same thing for that 4% rule, and allow that. And if people say, well, Steve, I like the idea of that annuity with the guaranteed income, but that's illiquid. And I looked at them and I said, well, wait a minute. If I've got your stock and bond portfolio and it's kicking off 4 to 5%, you can't spend that either. It's just as illiquid as the annuity is. So when we come down to it, a lot of people ask, which would you do? I said, well, that's up to you. I would prefer to do the one that I spend the least amount of money getting. So if you're out there trying to figure out how are you going to replace your paycheck in retirement, give us a call now. Ask for an income plan. Allow us to sit down with you and talk about how you're going to replace your paycheck once you're retired.
You know, if you retire with a 401k, the question usually becomes, all right, well, what do I do with it now? There are generally two options. You can either leave the money in the former company's plan, or you could roll it over to what's called an IRA. So, Steve, what should we know about each move, and how do you go about recommending options here?
Well, we look at it, in all fairness, there are 4 options when it comes to your 401k. 1, as you just stated, leave it where it's at. 2, roll it to an IRA. 3, if you're going to work for another company, you could, if they're willing to accept it, roll it into another 401k plan. 4, you could have them send you a check. Now, the first 3 are non-taxable events. Them sending you a check is a taxable event, and they're required to hold 20%. So those are the things that we look at. When we start to look at 401ks and IRAs, what are the advantages and disadvantages? Let's talk about some of the advantages of a 401k. In some 401ks, especially for the larger companies, the cost and investment fees could be lower. because of the fact that just the economies of scale with the large companies. So it could be lower. You can also tap a 401k at age 55. If it's the company that you just retired from and you haven't gone back to work, you can actually get money out of a 401k plan at age 55 instead of waiting until you're 59 and a half without that 10% penalty. So that is something that we have to look at for you folks that are out there that want to retire earlier than 59 and a half. And if you're a do-it-yourself person, there are very few to no options within the 401k plans. You're never going to really be overwhelmed when it talks about investments within a 401k. So it's completely the opposite if you move it to an IRA. You're going to have more, you've got more options in an IRA. Everything that's out there that's available that can go in an IRA account is available once you get to the IRA. The other thing that I find for a lot of our clients, they can streamline the accounts. We had one guy that had 7 401k accounts.
Wow.
And I'm going, this was back when 70 and a half was retirement, the age for required minimum distributions. I said, I don't care if you do anything. Make sure you get these all out of these 401ks by the end of the year. He goes, why? I said, next year, you're going to be required to make distributions. And if you have a 401k, you have to take the required minimum distribution from that 401k. IRAs, you can combine all those accounts together and take it from one. So it makes it a whole lot easier when it comes to that. But streamlining the way that you have 1 or 2 accounts versus 3, 4, 5, 6, or 7 accounts. Investment options. You have the wide array of almost everything that's available within an IRA account. We can look at if you want one of those personally funded pensions that I talked about earlier. That can be in your IRA account. We can move money out of the 401k or the IRA to an insurance company. It's still in an IRA account. It's a non-taxed event, and the income as it comes out is going to be taxable. So that is the big advantages that we look at. The other thing that people don't look at is most companies will allow you to move the money out of your 401k account at age 59 and a half. Some companies won't let you do it until you actually retire. So each company is going to be different. If you're not sure of the rules on that, give us a call. Let's do that 401k analysis. And if necessary, myself or a member of my team will get on the phone with you and your custodian for your 401k account and find out what the rules are and figure out when they're available to you now. If you have a 401k, 59 and a half, give us a call. Let's get together and do a 401k analysis to see what options we might be able to bring to you.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.